Time for our weekly market review where we analyze the markets to see if a correction or crash is coming. Because that's what we do at Fallible, right? Protect for the downside. Risk management, it's the most important thing you can do for long-term success in the market, and we help you do that. That's why I'm here. So first off in this video, we're going to go over equity markets, because you can see the market has been going down for a few days now. And I know we just did one of these market reviews, but because of the market action, people have been asking for another one. So here it is. After we're done with equities, we got to move into crypto, Bitcoin. And one particular part of cryptos, or really I should say blockchain, that I want to talk about today are NFTs. I'll explain what they are in this video, and I'll show you some numbers that are going to blow your mind. It's insane. And then we're going to wrap up with something very important from a billionaire fund manager. We've talked about this concept before on this channel, but just in case you didn't believe me, hopefully you will believe this billionaire. So you're definitely going to want to stick around for that. So as we said, markets look like they're taking a bit of a dip. Thankfully though, we got macro ops on our side to give us that sweet global macro research to figure out what markets are actually doing. So let's jump into it. First up, you can see from this chart right here that there is a persistent bid under this market in the form of buybacks. And they're running at a record pace since the start of the year. Buybacks are now averaging $6.9 billion a day this earnings season, which is the highest level since 2006. And you know we've mentioned corporate buybacks in many videos going back at least a few years. Because part of this bull market that's been going on since 2009, a lot of it has been propelled by companies just buying back their own shares. And why are they able to do that? Well, because money is so easy and free right now. Interest rates are non-existent, and the Fed is suppressing everything on purpose, so you got a lot of money floating around. And what are these companies going to do with all this money? They're going to buy back their own shares so that their own stock options as executives get pumped up higher, and everybody makes more money, right? And yeah, we do. The stock prices go up, we all benefit, they benefit, and it's a fun party until, the party stops. Easy money doesn't last forever, but while it's here, yeah, we can enjoy it. And that's why we track something like this. How are buybacks doing? They went on pause during the whole pandemic, but now they are coming back strong because a lot of companies actually saved up a lot of cash during that pandemic. So we can expect 2021 to be a strong period of these buybacks, which is good, bullish for the market. This chart right here shows every 10% or greater dislocation going back 35 years. So the point of this chart that you want to see is that these dislocations, and a dislocation is just a 10% sell-off. So each yellow line that you see here, you can see that the frequency of these yellow lines going back from the 80s to now, it's increasing. So what does that mean? Well, it means that markets are becoming more prone to large dislocations, and this is actually bullish. Why is it bullish? Well, that's because it extends the duration of the market cycle, because these frequent corrections, which we call trend thorns at macro ops, it keeps investors from leveraging to the point that it causes real instability. So every time you get one of these corrections, it shakes up investors a bit. It doesn't let them get too comfortable. And that is good for a bull market, because when investors get too comfortable and everyone gets too bullish, what happens? They start leveraging up. They put all their money in plus more. They take a second mortgage on the house, pile that in. And that's why we track sentiment, right? This is the same concept. When people are way too bullish, it's actually bearish for the market because they put all their money in and there's no money left to go into the market, which you need that constant stream of buying to push prices up. Whereas if everyone is bearish, then it is actually bullish for the market because there's a lot of people left to buy. So if we get these more frequent corrections, then it doesn't let people reach that euphoric stage and it extends the bull market. And this is the longest bull market since forever, right? Since 2009 till now. It's crazy and it's continuing to go on. Part of the reason why is because of these more frequent corrections. And I'll talk about this more in a few minutes, but the speed of this market is increasing because of social media and everything else. So it's not surprising to see that we get more and more 10% corrections. Moving on, everybody is calling this a bubble once again. The bubble callers are back after being in hibernation for the last few years. I myself, I'm in this group. I've been calling this a bubble too. But here's the crazy thing about bubbles, which you're going to see in this chart. This yellow line right here is the 3-year rate of change for the SPX. So in a real bubble, like back in the 90s, you could see it spent multiple years above the 100% mark. But currently, we're only at this 40% mark. So if that's the case, even if this feels like a bubble, and I myself call it a bubble too, it can still run. And based off this chart, this doesn't prove that it's not a bubble. I still think it is. But again, the point is bubbles can get way bigger than you could ever imagine. The market can stay irrational far longer than you can stay solvent. You know that quote. And remember what we're talking about here because it all leads into that lesson from the billionaire hedge fund manager that we're going to talk about. Very important. The Bank of America Fund Manager Survey, the latest one, is out. And again, we track this to gauge positioning in the market, which goes along with sentiment. Are people heavy in stocks? Are they heavy in cash? Depending on where they are, we can get an idea of where they may potentially move. And these aren't just people. Obviously, they're fund managers because it's a fund manager survey. So the bottom line from this survey is that the only reason to be bearish is that there there's no reason to be bearish. Sentiment on global growth is at an all-time high. The V-shaped recovery idea is finally consensus, meaning everyone agrees this was a V-shaped recovery. We aren't doing a double dip. Cash levels are at an 8-year low, and equity and commodity allocations are the highest since 2011. And what did we just talk about? If no one's in cash, how much more fuel do we have to keep pumping this thing higher? If everyone believes this is the greatest economy and greatest market, that's a lot of bulls, right? So you got to keep your eye on that. Cash is trash. As we said, the cash level is down to 3.8%, its lowest level since March 2013, and a record number of investors are taking higher than normal risk. It's a bull market. Everyone's going hard, putting their money in the market. A few charts from this same survey show that economic expectations are bullish, with the majority, 34%, saying it's that V-shaped recovery versus 10% 9 months ago. 91% of fund managers are expecting a stronger economy. This is the best economic outlook ever. See this blue line? Very high, new highs. Everyone thinks everything is great, and 84% of these managers are expecting global profits to improve over the next 12 months. And here's an interesting chart for you. Fiscal stimulus as a percentage of GDP. And we're comparing 2008 to 2010 in the light green here versus now in the dark green. And just look at this. US, Canada, Japan. Oh, and this gray part right here is new stimulus that's coming. So every country around the world is fiscally stimulating like never before. And we've talked about this in previous videos. So we have fiscal stimulus plus the Fed pumping too. Both of these two pillars of the economy are working together to pump this stock market higher and higher. And that's why overall we are very bullish. And all the data that we just went over is showing everyone else is kind of bullish too. So that's something you need to track, because if this is the consensus view, how much longer does it go on until it turns around? Well, from our research, we think it could go on for 1 to 2 more years. But in between that time, there are going to be corrections. If we're overall bullish, they're going to be minor corrections, but corrections nonetheless. So that is potentially what we're seeing right here. As of this recording, the equity markets are down. They've been down for a few days now. Now, in our last market review, we said we could see a 10% correction very soon. And if we look at the S&P right now, it looks like we're down only 2.5%, not even. So if this is the start of that 10% correction, we got some ways to go. 10% from highs would bring us all the way to this level, 3563, just about. So yeah, some ways to go from where we are right now. But again, that's a minor correction within a larger bull market. Now, the way we play it with our system, with the Fallible strategy, is that with all of our stocks on this nice bull run higher, we've been taking profits. So when this market turns around, we have a lot less exposure and we're going to lose a lot less. While we've been taking profits, we've also moved our stops up. So again, when the market drops, we're going to get out of our stocks pretty quickly, and we're going to keep those gains that we made. Now, of course, some of you will respond with, why would you do that? If you think this is a long-term bull market, why are you going to sell anything on a small 10% drop? Well, that is risk management, because the truth is we don't know if it's just going to be a 10% drop. It might turn into a crash. We can't predict the future. That's why you're constantly managing your risk, because you don't know what's going to happen. The market is uncertainty. So how you deal with uncertainty in any system, not just the stock market, is through those management principles. The reason cars come with a spare tire is in case your tire blows out, right? If you got a really great car and you really like the tires and you don't think there's a chance of it happening, do you just say, screw it, I don't need a spare? No, you don't, because that's stupid. That's the same idea here. We don't know what's going to happen, so make sure you're protecting yourself. And trust me, our returns with the system are killer, even with the risk management, because the risk management isn't a bug, it's actually a feature. It helps with those returns. Right now we're up 14% and the rest of the market is up 5%. And when the market drops, because of our risk management, you really see those numbers grow apart. Our returns look way better than the market. So there you go. There's your dose of risk management that you can come to expect from Fallible all the time. But the next thing I wanted to talk about is Bitcoin. And here is the chart I wanted to show you. This is the annual electricity consumption of Bitcoin compared to every other country. Look at Bitcoin. It's like a top 30 country. It's the same size of electricity consumption as Pakistan. And that's a country of 217 million people. And a lot of people don't think about the electricity that Bitcoin requires because of all the mining and maintaining that blockchain. It is a lot. And as Alex says here, and he's our lead researcher in macro ops, he's not sure how this ungreen credential is going to sit with our game masters. See, if Bitcoin's price ever reaches $1 million, it will output more carbon than the entire US and consume 2 times the entire electrical production of the US. Bitcoin is not so environmentally friendly. And as Alex says here, this is just one reason amongst many on why Bitcoin will never be a credible currency or store of value, but instead just a vehicle for speculation. And oh man, I guess Alex wants a lot of digital pitchforks coming at him with that statement. But I tend to agree with Alex and Ray Dalio. I just don't see how Bitcoin becomes a currency for many reasons. Big reason being that the governments want to control everything and they won't let that happen. But we're not going to argue that in this video, don't worry. What I did want to show you is an offshoot of Bitcoin and blockchain. It's something called NFTs, which are non-fungible tokens. So an NFT is a special type of cryptographic token which represents something unique. And basically what we're talking about here are like trading cards, like Pokemon or baseball cards. It's a collectible and there are very few available. And it doesn't have to be trading cards, it could be art or anything. Basically an asset that is scarce. And it's something that doesn't actually provide any value other than just being there. Like, what value does a Pokemon card have? It has as much value as people place on it, right? So it's that whole concept, but then put on the blockchain. So you could say, okay, we have this amazing trading card, it's virtual and it's verified by the blockchain to say that you have the real copy versus anyone else. Maybe there's only 15 available, so only 15 people in the world have it. There's no way to duplicate it or anything. Great, right? Yeah, okay, cool. Now take a look at this picture right here of this pixelated, stupid looking mohawk guy with some stupid glasses, not even smiling, even though he should be smiling, because this CryptoPunk 1737, he is worth almost $66,000. Yes, this literal NFT picture right here, worth $66,000. It is insane, and this whole NFT space is blowing up right now. You got guys like Gary Vee all over it. Logan Paul, the big YouTuber, he released an NFT of himself and made $3.3 million in a day. You may have heard of NBA Top Shot, which is basically like digital basketball cards, but it's more than just cards. You can save a special play that happened in a game and they're selling it. And yeah, it's all just crazy. And one of my big points with all of this is that things are just moving so fast right now, and everywhere you look, there is something that you're missing out on. Like NFTs, I don't stop seeing tweets about it. It's very annoying because people are speculating in it. And then they look at you like, if you're not involved in it, oh, you're missing out. This is the next big thing. And this is the constant mentality that we're all bombarded with now. Like, hey, you're missing out because you're not in this, you're not in this. This thing is moving, jump on this thing. And it's becoming worse and worse because things are moving faster and faster with social media. And it's gonna make you crazy. It makes you anxious. It does the same thing to me. So in these times, it pays just to get laser focused and put on tunnel vision, really. Because a lot of these things, especially NFTs, in my opinion, are a distraction. They're gonna be here for a while during the bubble and then they're gonna be gone. So when I think about it, I think about what is tried and true that works, that I could keep focusing on instead of getting distracted by all these other things. And obviously you hear my dog going wild right now. Sorry about that. What to do? But like I was saying, even if NFTs do blow up and they're not just a speculative bubble that comes crashing down, I don't care. I'm just focused on my thing and I'm making great money. So don't get distracted by all these other things. It's okay to not be involved in everything. It's okay not to know everything. But the big thing with that is also just don't care. Don't worry about it. Don't let it drive you crazy. Just stay focused. Now this brings us to our billionaire fund manager and his thoughts on bubbles. And I'm talking about Michael Steinhardt right here. And him, you can see his picture right here. He is worth over $1 billion. Famous fund manager, you've likely heard of him. But he talks about a period when he was trying to short Polaroid. So he said, we went short Polaroid when it was selling at 60 times earnings, which we thought was absurd, but then it went to 70 times earnings. The market seemed to lose track of reality and we found ourselves asking, what is the difference between 40 times earnings and 80 times earnings? By putting a different number on the secular growth rate estimate, you could justify almost any multiple. And that's how people were thinking in those days. And this is a concept that we've talked about before, and it applies to everything we talked about in this video. First being, valuations don't matter because people can value anything at any level. Look at this CryptoPunk valued at $66,000. It's crazy. But what you don't want to do during periods like this, and there's always going to be periods like this, right? There's always going to be bubbles and busts. You never want to step in front of that train like Steinhardt did right here trying to short Polaroid. It just kept going up. So you hear me say all the time in these videos that, hey, it's a bubble, it's going to bust. But again, we don't know when it's going to bust. So just like I was talking about before, where we don't know if this is going to be a 10% correction or a crash, so we manage risk either way, you do the same thing on the upside. You don't know if the bubble will go on for 2 more years or 2 more weeks. So you manage for every scenario. And the best way I've found to do it is with a quant system. That's why the Fallible system is all quant based. What is the market doing, and play based off of that. So our quant system, it finds the highest momentum stocks and we invest in those. We got the little TSI scanner, right? It takes all the stocks in the NASDAQ and ranks them by their momentum readings. And what we do is rotate into the top 5 highest momentum stocks each month. And that's it. Beyond that, we manage risk. We have risk control in place. We're not actually worried about whether it's a bubble or not, because it doesn't actually matter. We're playing what's in front of us and we have the proper precautions in place in case something happens. And that's how you make money. So we could talk all day about all these things and what it should be, like, oh, we shouldn't have all this speculation, the Fed shouldn't be doing this, blah, blah, blah. But who cares? It is what it is. You either play it or you don't play it. And me personally, I rather play it and profit. And the equity market is my game. when it comes to investing. Every week I tell you I still haven't invested in Bitcoin even though I want to. And that's because most of my money is still going into the equity market. You won't see me in NFTs because to me they're just a distraction. There's going to be more things that I'm going to miss and I don't care because I'm just focused. I'm doing what makes good money for me. You only need to know a little bit in this world to be successful. And then the key thing is to focus on that little bit and don't get distracted. So as always, if you want to learn exactly how our strategy works so you could use it yourself, just check out our training. I'll put a link in this video and down below in the description and comments. Shows you step by step what we do in the market, myself and all our Fallible members. So you'll learn more about how to use this quant strategy. Again, pick one thing and focus on it. It doesn't have to be this thing, but you might like it. I think you will like it. So if you haven't already, click this link right here. Go take that free training. Works for me, works for all our Fallible members. It might work for you too. Click this link right here and I will see you there.